1929, by Andrew Ross Sorkin. Audiobook summary and review by StoryShots. Markets fall faster than they rise, but they remember longer than you expect. Introduction. October 1929 was not just a stock market crash. It was the moment when mass delusion met mathematical reality, wiping out billions in paper wealth in days and ushering in the Great Depression. That is the thesis of 1929 by Andrew Ross Sorkin, a forensic examination of how excessive speculation, unchecked borrowing, and institutional blindness created the worst financial catastrophe in American history. The crash was built into the system years earlier. The crash did not begin in October. It began years earlier, when margin lending became the norm and anyone with a bank account could borrow 90% of a stock's price to buy more shares. When prices finally turned, forced liquidations created a death spiral. Investors who bought on margin had to sell to cover their loans, which pushed prices lower, which triggered more margin calls, which forced more selling. If you are investing with borrowed money today, you are playing the same game that destroyed an entire generation of wealth. The market can remain irrational longer than you can remain solvent, but when it turns, borrowed money turns winners into beggars overnight. The real danger is not the crash itself. It is the false confidence that makes debt feel safe. Insiders quietly sold while telling others to buy. While retail investors poured their savings into stocks, the smartest people on Wall Street were quietly selling. Joseph Kennedy and Bernard Baruch got out months before the crash. They did not announce their exits. They cashed out while telling the public that stocks were still a buy. The insiders understood something the crowd did not. A market driven by borrowed money cannot sustain itself. The lesson is not that insiders always win. It is that when the people closest to the action are quietly heading for the exits, it does not matter what the headlines say. You are watching what they say instead of tracking what they do. When the shoeshine boy starts giving stock tips, the smart money has already left the building. Here is where it gets darker. The recovery took longer than the crash because trust disappeared. The Dow Jones lost 89% of its value from peak to trough, but the real damage was not the numbers. It was the destruction of trust. Investors who lost everything stayed out of the stock market for decades. Banks faced runs for years because depositors no longer believed their money was safe. The economy did not recover for over a decade because the crash shattered the belief that the system worked. Without trust, capital freezes. Without capital, growth stops. Wealth can vanish in days, but confidence takes years to rebuild. The investors who survived were not the ones who timed the bottom perfectly. They were the ones who understood that recovery is never a straight line, and that staying solvent long enough to participate in the rebound matters more than catching the exact low. Crashes always feel worse than the rallies that follow, because fear burns deeper into memory than greed. If someone you know keeps asking why crashes leave scars that last decades, send them this summary. Final summary. But the three-part framework that shows how speculative bubbles always follow the same pattern, the specific warning signs Kennedy and Baruch used to time their exits, and the policy mistakes that turned a crash into a decade-long depression have not been covered here. One additional insight: the psychological tricks investors used to rationalize holding losing positions until they had nothing left, and why those same rationalizations show up in every bubble since. 1929 by Andrew Ross Sorkin is essential reading for anyone who wants to understand how markets break and what separates the investors who survive crashes from the ones who disappear. We are putting together the full summary of 1929 by Sorkin right now, with a visual infographic breaking down the crash timeline and an animated video showing how margin calls created the death spiral. You can follow the book in the StoryShots app to get it the moment it is ready.